Hello there again. This is binary options trading strategies. This time we'll use a classical technical analysis pattern. It's called a wedge and it forms extremely often on various currency pairs, on various time frames. All we have to do is to stay focused in correctly identifying the wedge and setting the striking price and the appropriate expiration date. I will use two video analyses and articles to explain the concept, and in the first one we'll use the definition of it and the rules of the whole trading theory, and in the second one we will look for examples in order to see exactly how to use these wedges. First of all, wedges are reversal patterns and they look something like this. In a bullish trend or at the end of a bullish trend, a wedge looks like this. It has 5 different shapes or 5 different waves if you want. This would be a rising wedge. A rising wedge signals a bearish move, or we would like to trade put options. And the falling wedge forms after a bearish trend, so the price forms something like this, 5 different waves, and then of course reversal comes. We want to buy call options after a falling wedge. Where is the wedge? Well, it's very simple. A wedge forms between 2 trend lines. So all we have to do is to define 2 trend lines and the price action between those trend lines show the shape of the wedge. So this is the rising wedge signaling a falling move to come, and the entry price or the striking price for our option would be at the moment that this trend line, this is the so-called 2 to 4 trend line in Elliott-Wade's analysis, because this kind of a move usually forms at the end of an impulsive wave with the Elliott-Wade's theory. With the classical technical analysis, simply wait for the so-called 2 to 4 trend line to be broken, or the lower part of a wedge in a rising wedge, or the upper part of a wedge in a falling one. Typically the price goes and retests this 2 to 4 trend line, but this is not mandatory. Our striking price needs to go and needs to be at the moment that this is broken. Therefore, that's the great entry or the great striking price for a rising wedge. How about a falling wedge? A falling wedge forms at the end of a bearish trend. Typically this is the 1 to 3 trend line, and most of the times the price goes and pierces the 1 to 3 trend line before a major reversal to come. But that's not a mandatory thing to consider. While most of the times the market goes and pierces the 1 to 3 trend line, it's not the most important thing. What's really important is to go and wait for the 2 to 4 trend line to be broken. Of course, that the risk reward, if you want, ratio would be better if the entry takes place at the opposite, when price breaks the opposite side of a wedge, but this most of the times gives a random signal, and it's not such a disciplined approach to trading. If you want, in terms of money management, that would be a place to buy a call option, but with a limited investment, and the real one to come by the time the price comes and confirms the break here of the wedge, and then that should be the perfect striking price for the option. How about the expiration date? So in the case of a rising wedge, that would be the aggressive approach, and the conservative approach is to wait for the 2 to 4 trend line to break. How about the expiration date? That's very easy to set. First of all, we gotta look at the time frame where the pattern forms. In this case, it is the 4-hour chart, so any expiration date that goes lower than end of day would be inappropriate. So we need to go the end of week, the end of month, for example, and so on this 4-hour chart. If it is on the 5-minute chart or on the 1-minute chart and so on, we can go with lower expiration dates, with shorter expiration dates, of course. Another way to set the expiration date is to simply measure the time taken for the whole wedge to form. So from here to here, we measure the time taken for it. This will be the time. Then project that time on the right side. So we should clone this one and try to take it from here. Project this time on the right side, like this. And then you simply take a vertical line and put it somewhere, split the time in two, like this. Normally, in strong and very strong reversals, price goes and completely reverses 50% of this wedge. So 50% of the wedge would be something like, what, something like this. 50% of the wedge in less than 50% of the time taken for it to form. So again, in order to set the right expiration date, we measure the time taken for the whole pattern, for the whole wedge. We project it on the right side. By the time that we project it on the right side, we split it in two, and price normally should come and retrace completely 50% of the wedge in less than 50% of the time. And that will be our expiration date, shorter than this time. Because if price, by the time that it breaks the 2 to 4 trend line here, this trend line, if price is not able to retrace this amount, this distance, in less than this time, and probably this was a fake signal. These are the rules for trading wedges, rising and falling wedges. This is a rising wedge, forms at the end of a bullish trend. Actually not this one, because it's not quite good. At the end of a bullish trend, so we gotta have a bullish trend before the wedge to form. And this is a falling wedge at the end of a bearish trend. Now let's go and see some examples both on this time frame and on different time frames to see how to apply binary options trading with rising and falling wedges. Bye bye.